tell us what that worked from 2020 to 2022, and now what is the trend happening from 25 onwards? What are you foreseeing?
Okay, so from a fund standpoint, this is a very interesting topic for us because we always said consumer is not as, the disparity in your return expectations is not linked to how markets work. So you will have introduction of new channels, you will have introduction of new categories, and you bet on those. It's very long-term oriented compared to looking at a 2-year window, right? So internally we joke about it saying 2020 to 2022 was just madness. We don't think that that's normal. We don't think that that's, this is not the new normal, this is normal. That was an anomaly. Yeah. Having said that, what worked during that is I think the number of providers of capital shot up very significantly around that time, and we're seeing even more happen now. But those of you who know of our portfolio or have interacted with us would know already that we've always said bottom line matters as much as the top line because consumer doesn't scale like tech. So you underwrite things differently. That to us is the biggest difference, and then what we were saying during 2020 to 2022 did not resonate with too many people because in a room of 10, we would be maybe one of two people who spoke like that. Post that, however, when quote-unquote funding winter happened, everybody said, oh, but you were talking about it, you know. So that to us was the difference in a big way. I think people just got back to first principles, building fundamentally like a business was supposed to be built, not building for VCs, if that's how I would sum it up.
What about you, Aniket?
So, I mean, between 2020 and 2022, I think businesses itself had to relook at what their strategy was. I mean, obviously, the pandemic was something that none of us ever saw. And while a lot of businesses came to a sudden halt, I think the ones that did well then and then led to this whole D2C trend that emerged were people who were able to pivot and go to have a digital first strategy, because suddenly all of us were spending a lot more time on devices, screen time was a lot, so therefore attention on what you saw on the screen was something that everybody sort of garnered for, so ad expenses, etc. shot up then. So I think brands that could sort of pivot to that did well during that period. But then why that has sort of faded, to get to your second part of your question, why that has sort of faded was that, I mean, obviously that was a period of time that was such a blip from how normal lives were sort of run, that people did go back to old ways. So people did want the physical touch, people did want to go back to offline ways to shop. So having a digital first strategy meant that things like customer acquisition costs at that point in time really shot up because everybody is vying for that same digital ad space. But I think people who could then sort of think of having an omni-channel approach helped people to sort of meander through those times between 2023, 2024. And I think people who are looking at it holistically now are the brands that are continuing to sort of do well.
So now the funding trend is more slow, selective, strategic. What is the winter is almost over. So what is the trend now?
This is interesting because, you know, most people forget that we also have timelines. What that means is you raise a fund, you have 5, 7, 10 years depending on where you're playing to actually deploy that. As anyone would want to, the first half, maybe the first quarter of that fund life would be reserved to deploy monies, see the portfolio grow, and then exit. So those are our phases. What happened interestingly is a lot of people had picked up money during COVID, right? So we had fresh funds. Everybody was sitting on cash. A lot of people are still getting cash from those funds. This is mainly because we didn't, for the first time in a long time, meet founders, right? And these were 7-year journeys that we wanted to ride with people, saying, this doesn't happen on a Zoom call, but people were underwriting like that and issuing term sheets. And beyond a point, you lose that sense of self and say, okay, we've done it once, we keep doing it over and over again. And a lot of people tried doing that, right? So it's not so much funding winter, I would say same number, maybe more capital providers today. But there is a heavy index on selection. Because as many capital providers you have more startups today. Not everyone's going to get funded. I think that's the difference versus 2020 times to now. So I think we just got more cognizant, we meaning I'm speaking for the fraternity, I think, is everybody just got way more cognizant saying, suddenly you have so many founders, now you can pick.
Yeah.
So that's an option.
Aniketh, what's your thought?
Yeah, I think one of the things that went really crazy at that point in time were investment multiples itself.
Oh, yeah.
I think everybody thought any multiple that, like I think you were saying earlier, because top line growth was given such high prominence. So the cost at which you got that growth didn't really matter because there was a lot of capital available as well. Multiples really sort of shot up. I think for people who deployed capital heavily in those periods, they are now finding it hard because some of those companies, I mean, in our investment world parlance, a down round is basically you raised money at a valuation that was high and you're not able to attract investors post that at that high valuation or higher. Ideally, it should be higher. But in which case, if you're doing a down round, which is at a lower valuation, the investor does not want that, the company does not want that. And you're doing a lot of disservice to the nice business that they may have built. It might have still been a good company, a good brand, but the viability of it succeeding financially, economically is you sort of shot it in the leg. So that's something that I think investors are now wary of as well. I think things like unit economics, focusing on bottom line growth, profitability is as important, if not more, than just chasing top line growth. And we're okay with doing deals at lesser investment multiples if we believe the path to scale up is sort of linear.
Right. So Aniketh, you also touched upon the omni-channel point. So is it now absolutely necessary for all digital first brands to at least have some kind of a physical appearance or at least an omni-channel, basic omni-channel? Is that where the world is now going? Is digital first almost ending now?
See, I don't think there's a one-size-fits-all model. I think, so take one company in our portfolio, the company called Snitch, which is in the fashion, apparel, retail space. It started as a digital-first brand. But I think beyond the point, it figured that to establish credibility, trust with the good customer base that it has built online, maybe having some offline presence is important. And actually that journey of starting digital first and then moving offline helped them because, for instance, they were really good at analyzing the data of customers that were transacting on their platform. So even things as specific as the latitude, longitude of where the customer is based or where orders are coming from can give you insights to set up your first retail store. Right. And they're now, I think, at about 55 retail stores. So like that, so you could have a digital first brand that figures out how to get into the offline space. It could be the other way around as well. Yes, ideally, the more face time you have, be it digital or in the physical world, can theoretically help a brand, but I wouldn't get excited if a new company comes up to me and tells me straight away that, hey, this is what I want to do, because they believe that's what I want to hear, because I want to see a good path to getting there, and when it makes sense to unlock newer channels, do that at that point and we can have a conversation. It's anyway a long partnership that we have with the companies that we invest in. So over the course of the fund cycle, like she was mentioning, you will also work with the company in different ways. So it could be digital first and offline later, or it could be the other way around as well.
What about you, Pooja?
I think omni-channel is usually interpreted in a certain way. We've always said digital first after COVID, right? I don't think that channel existed. So omni-channel to me actually came the other way around. Most people said, oh, you started online, but now you go offline. The world worked a different way until maybe 2016, 17. There was no online, right? And then a bunch of things happened. Marketplaces opened up. We believe if you have, let's say, 100 rupees, $100 to spend and attain a certain run rate, in most cases, I wouldn't say all, but in most cases, an online first strategy helps you collect a lot more information and get predictive analysis to go offline. Offline might be more profitable, don't get me wrong, but online will give you a lot more method to the madness. Yes, you have to go offline. The point at which you go offline, I think, has changed. Because we keep talking about percentage of online revenue in a particular category, and the depth there has increased massively. In categories like beauty and personal care, how many brands do we know of that started 6-7 years ago and may not have offline presence even today? We don't know what the outer limit is. I think we're also learning how much you can go deep into a channel, but I think it's inevitable. If you want to build something that's long-lasting, 20 years out, still exists in the mind of the consumer, you will have to be offline. So
basically, to test the waters of going into Bharat, both the channels are required, right?
Yeah, absolutely. I think that is, there's no question there. It's a matter of sequencing, which you do when, but I think it's inevitable. You will have to do both.
Right. So all these brands, earlier we had these categories like beauty, fashion, scaling fantastic revenue through digital first. What are the categories which you foresee are going to stand out more? Because now beauty is at a decline. There's so many that they're not able to sustain themselves, right? So which are the categories that you foresee?
So this is very interesting because and we got this question a lot a few years ago when Amazon, Nykaa, everything was becoming a big deal. Food did not scale online for the longest time unless you were playing in commoditized / pantry essentials. Food did not really scale online. With quick commerce, we've seen that completely turn. And imagine the number of times you order food, right? So the number of occasions of consumption, how quickly you can get something, and also how lazy everybody has become. Combination of all of that in general leads to food and beverage brands scaling so significantly. We've seen 2-3 brands at least who are in the portfolio who would have started on quick commerce have gotten to a 100 crore run rate within like 3 years of launch. Unheard of in food.
Can you give us examples? I know which ones you're talking about, but let's hear.
So the most obvious one is actually Go Zero because so ice cream existed offline. Everybody in the room would have tried ice cream through parlors. Then you had tubs from people like Amul, but you never saw an ice cream brand scale in the digital channel, 10-minute delivery to your house with shelf life.
Right.
Unheard of. This was a very interesting thing that happened, everything coming at once, but our thesis was ice cream will move to this because it's impulse first.
Right.
So now if you have an occasion of consumption, you have somebody who will say 10 minutes wherever you are. You have something at a midnight craving, you will order ice cream, and people disturbingly order ice cream. So we've seen that play out really well.
So FMCG is now scaling, and that's the quick commerce is the path.
Yes. Yeah. So quick commerce actually has delayed offline, we think, to some extent, because it's given you another sort of window where modern trade is now a little bit questionable as to should you really go into these stores right now, is it worth it? Will you really get that much level of delta? Is it a needle mover? You can push it out. Right. So there's an online website where you collect data, then you go on to something like a quick commerce. For your first 200 crores, give or take, you can build out there, and very nicely. You don't need to use too much money to get there.
You know, you raise a very exciting and a very, very controversial point, quick commerce versus kiranas.
No, kiranas are here to stay. Modern trade is still under question, we think. So, yeah.
Lovely. So, Aniketh, which are the categories that you foresee?
I think I would look at it so just take India itself specifically. If you're trying to build something for India, just break it up into a segment of the population that is likely to spend. And you'd like to believe that because India, majority of the people are fairly young, so anything that's catered to them will sell. But I don't think that's always going to be the case. So for instance, even fashion, apparel, for the Gen Z crowd, I think could potentially take off. But even take the older population. I mean, we had, while we were all growing up, our parents worked really hard to ensure that our future is sort of better than what they went through. So a lot of them are getting into that senior or already gotten into that senior geriatric sort of population. So I think even products built for segments like that, because today's generation maybe is children are living abroad, but they still want to do something for parents here. So things like, I mean, categories like, for instance, take a category like adult diapers, for instance, which I think there's also a stigma associated with the fact that, hey, I won't wear it. But something like that is so underpenetrated today as a category that maybe something like that I would believe will take off with the right sort of focus and the social stigmas that are sort of removed away from it. Similarly, older folks end up falling a lot, and children now want to ensure that they are or help is available to them as soon as something like that happens. So I spoke to a couple of companies that were just looking at devices for the older folks, looking at devices that you set up in the room itself that could detect a fall, trigger a chain of help, emergency services associated with that. So these aren't your typical D2C brands that you would think can really scale up, but if you believe that the propensity to spend for things like this can exist, then I believe categories like this, which are severely underpenetrated, at least in a country like India, can really see that growth that maybe some of the typical categories like quick commerce or food, etc., will find it hard to sort of match up to.
I was speaking to someone from Rukum Capital a few days ago, and she also mentioned this thing: seniors, products for seniors, services for them. This has become a category that India is not working towards. We have very less, right? So if any of you are interested, it's a category you can explore. So, but that is interesting. Thank you so much. But my last question is about the D2C brands who have already scaled in India and now want to go global. So what are the ways that they can do that? How does a VC fund help them?
Yeah, I can start off on that. And I'll probably give you a little bit of, so from my experience, so I used to work, before I got into the investment role, I was working at Zomato, and Zomato at that point in time, I think this was between 2016 and 18, were actually present in 22 countries. So it seemed like going global or going all out global made sense, but Zomato actually pulled back from a lot of those countries over a period of time, because as they got more data and they figured that going all out is not as effective as having a specific surgical strategy towards which countries you want to go in first. So Indian brands look at the Indian diaspora itself in the global setup countries that like a lot of these newer brands. Take even an old brand like Haldiram's, for instance, which I think continues to do well. And my brother who lives in the US actually talks about SKUs in Haldiram's portfolio that I haven't even heard of that I'm quite excited to try. So I think brands that can tap into things like that, maybe the Indian population is one, maybe certain countries that enjoy or that are similar to India launch there first. I think normally a lot of the companies that we end up speaking to, the typical strategy, although I wouldn't like to bucket it, is if it succeeds in India, then our global strategy would be go to the UAE next, because the market is fairly similar, price points are similar. If it's a health product, maybe look to target the US first, because if you get the FDA clearance there, then a lot of the other companies, countries sort of open up. So I think it depends on the product and depends on the category. But going all out from day one, if a company comes and tells me that, yeah, I think my 5-year plan sort of says that I will be in 10 countries, 20 countries, it won't excite me as much as show me how you get to one country and how will you grow within that. And that to me is a more viable sort of plan to action.
Right. And Pooja, what is your take on it?
No, I think 200% aligned on that, right? Because one of the big things that our investors actually ask us is, what is the market depth according to us for a brand to get to in India? If you see brands that are built, even though maybe it takes 7, 10 years, 15 years to get there, 1,000 crores plus in revenue, and multiple categories, right? It's not like only one subcategory will get there. If you have that much depth here, for every minute you're spending on trying to do something outside, the number of resources, bandwidth, your own time that goes into doing that is pretty significant. So you need to evaluate what your opportunity cost is of doing that. So that's one. And many brands in our portfolio who started out 10 years ago are now thinking about doing that because they've crossed these thresholds. But the most obvious way of doing this is actually what some of these folks have done with Amazon, right? Because again, if you want data and you just want to try this out without getting working capital stuck, because otherwise you send goods and you don't know what happens to them, is sell through a platform and try to get understanding of where it's selling, why it's selling, and what can you replicate from that. So it has to be data driven, is the most obvious thing there. And I think I would speak for us for sure when I say this is, when most people are looking to go outside or test the waters, we actually have a program with Amazon where we work very closely on an aspect like this, right? So this makes sense, but we genuinely don't believe anything over a pilot makes sense at most of the, at a 50-60 crore run rate, you should really ask yourself why you're not thinking about 500 here instead of thinking about 20 there. So yeah.
So we, of course, work with a lot of brands and they tell us their plans. Most of them, what they tell us is either they go through this Amazon way, or a little bigger companies, they say they are setting up shops in like UAE malls and all that. So is that also a trend that you see, that they're first setting up one shop, two shop in one strategic place and then going on? Or is online first is what the D2C brand should do?
No, it's not about should. I think what we've seen is in certain touch and feel categories. So if it's, for example, luggage, if it's, for example, jewelry, don't need to be online. Evergreen is evergreen, it will sell everywhere. But if it's something as specific as apparel, like India wears clothes very differently from what the US is used to, right? Yeah. So those kind of nuances come into play, prints come into play, inventory comes into play, and it's not appreciating inventory. That's where it makes more sense to at least evaluate some sort of a pilot, figure out what is making sense, what's not making sense, and then double down. But honestly, categories like bed sheets, and we were stunned when we found out, this was during COVID, and we thought it was a COVID phenomena, it's not. We thought a lot of people in the US buying bed sheets from India was happening because supply chain, people were not able to deliver there and so on and so forth. Huge category when it comes to exports.
Bed sheet. Wow.
So in those
cases, categories, please look at that.
So in those categories, it makes sense to experiment online because why not? There's tailwinds already. You'll be sitting on momentum there.
Yeah. So I'll open the floor for question for 5 minutes and then we wrap up. Anyone has any question?
My name is Madhav and I am from Eastern region of India. We are into offline retail or FMCG. We have about 3 to 4 lakh customers, but the database is around 5,000 to 10,000. So our product is into sweets, namkeen and bakery. So it's over the 5 years we have served the customers. So we are looking to scale it through packaging business. So for that, what do you say, how should we go ahead, or how should we approach the investors? Probably not now, but 6 months from now is what we are looking at.
Um, I think something like this, if you've already got a good sort of hold of what your traditional business is and you want to move to a new channel, in which case this is packaged goods, and then that will open up opportunities like selling online and because you're already saying you're in a lot of retail stores at the moment. I think a category like this will need some amount of, typically what I've seen is some amount of angel funding, friends and family funding is what gets it started. And then once you're able to show some amount of growth is when an investor could come in. I think for consumer brands in specific, and if there isn't, although my view also might be slightly biased because we look at more of tech-based plays, etc., right at my current firm and where I was working previously. So we try and look for differentiators in the products that are being sold. So in this particular case, it may not be the food item that you're specifically selling. It might be more of branding and marketing that at this point hasn't been sort of proven yet. So I think if your current traditional business is doing well, and if that itself is generating surplus to take an experiment of this sort, you could try that out. There are specific avenues. You could start off with a marketplace approach itself to sell it. Your margins, etc., you will have to share it. Might not be as attractive as going your own D2C way. But it will give you some insight to whether customers are liking it, what's the feedback they're leaving, to then sort of do this on a more larger scale, by which time I think investors can also come in and sort of take notice.
Ma'am, from your side.
No, I think you should. Have you heard of this brand called Modern Kitchens by any chance? Uncle Chips. The audience will know Uncle Chips, right?
They have fantastic potato chips.
Yeah.
One of the reasons for my size.
No, but what we've seen is a lot of old school brands, right, have listed on quick commerce, and in a funny way have made a comeback with the new generation because they never tried Uncle Chips growing up. There was this middle generation which tried it, which discovered it and said, oh wow. And then the house started consuming it, and the sales of these brands on these channels is pretty insane. So when you're thinking about packaging, you should think about packaging for the digital channel. There is so much headroom. If I remember the number correctly, I think it's roughly about 150 to 200 crores a month is the size of the category on the quick commerce platforms. This is 3 platforms, not even all of the 6. So getting to whatever you're shooting for in a very short span of time is possible. So I would actually recommend building for that so that you get momentum. Offline will take a lot from you because the volume to price ratio does not make sense in the early stages. So.